The headline everyone predicted for a decade is finally here. Gold has officially crossed $5,000 an ounce. As of January 27, 2026, the king of metals is trading at historic highs, leaving millions of investors asking the same urgent question: is it too late to buy? Have you missed the boat, or is this just the beginning of a new, permanent baseline for wealth? Today, we aren't just looking at the price, we are looking at the why. We are breaking down the Greenland Tariff shock, the central bank scramble, and the mathematical reality of debt that suggests $5,000 might actually be cheap in the long run. If you're sitting on the sidelines with cash, this is the most important 15 minutes of your financial year. Psychologically, $5,000 feels like a ceiling. Our brains are wired to think that because it was $2,000 just a few years ago, it must be expensive now. But price is what you pay. Value is what you get. In 2026, the US dollar has lost significant purchasing power. When you look at gold adjusted for the 2025-2026 inflation spike and the massive expansion of the money supply, gold at $5,000 today is roughly equivalent to gold at $2,500 3 years ago. You aren't paying for growth. You're paying for protection against a devaluing currency. The question isn't whether gold is too high, it's whether the dollar is too low. Why did we hit this peak today? It's a perfect storm. First, the Greenland Tariff and the resulting tensions between the US and Europe have created a massive hole in Western resource security. Second, central banks, led by China, India, and even smaller nations, are currently buying gold at a rate of nearly 200 tons per quarter. They aren't buying for profit, they are buying for survival as they move away from the dollar-based system. Finally, the US Federal Reserve is meeting this week, and the markets are pricing in a 50 basis point cut because of the mounting pressure from the White House. Lower rates plus higher debt, a rocket ship for gold. This isn't a bubble. It's a fundamental repricing of the global monetary system. Many investors are saying, I'll wait for a correction to $4,500. But here's the risk in 2026. Physical supply is extremely tight. While the paper spot price might see a temporary 5% or 10% pullback, the premiums for physical coins and bars are surging. We are seeing premiums of 20% on American Eagles right now. If you wait for a dip in price, you might find that the physical metal is simply unavailable when you want it. In a structural bull market, the dip often happens so fast that retail investors miss it, or the premium eats up any potential savings. In 2026, time in the market is proving far more valuable than timing the market. Is there still upside? Major institutions like Goldman Sachs and JP Morgan have just revised their end of 2026 targets to $5,400 and beyond. Some stress case models are even whispering about $6,000 by next spring. Why? Because the structural issues, the $35 trillion US debt, the global shift to a multipolar world, and the industrial demand for silver and gold, aren't going away. If these targets are reached, buying at $5,000 today still offers a 10% to 20% gain in a year, a return that most savings accounts can't even dream of, especially when you factor in the hedge against systemic collapse. If you decide to enter now, don't go all in at $5,000. Use the dollar-cost averaging strategy. Buy a small amount now to establish your position, then buy more every month regardless of the price. This lowers your risk of buying at a temporary local peak. Focus on liquid, recognizable physical assets, 1-oz coins, and 100-grime bars. And remember, in 2026 the goal isn't to trade gold, it's to own it. You are buying insurance for your labor and your future. It feels late when the price is at an all-time high. But history shows that in major monetary resets, the highs of today become the dream prices of tomorrow. Gold at $5,000 is a signal that the old world is changing. Whether you buy now or wait, the most important thing is to understand that holding cash is also a position. And in 2026, it's the riskiest position you can take. Stay physical, stay patient, and keep stacking. Subscribe to channel.